What would happen if we took a real small business owner, put them in the hot seat, and broke down their tax strategy live right here? That's exactly what we're doing today. Meet Eric. He runs a successful appraisal business, pays himself through an S corporation, and just dropped over $50,000 to the IRS last year in taxes. But could that number be slashed legally the right way? You're about to hear a real-time unscripted tax saving strategy session that might just change how you think about your own taxes. And if Eric's story sounds familiar, it should, because this could be you as well. So Eric, welcome to the show.
Thank you, Mike. Thanks for having me on.
Yeah, and I'm super excited for this. This is the first time we're doing like a case study, a live case study, and Eric and I, for the first time, we've had conversations through email, back and forth, but this is the first time meeting for the first time. So, this isn't some pre-scripted type thing. This is just me and Eric kind of hashing out, and we're gonna have a fun discussion. So
Absolutely.
What I want to do first is give a little breakdown about Eric's situation, kind of what he has going on. That's going to help lay the groundwork for some of the things that we're going to be talking about today. So a couple things that Eric has. He has a Vanderwall Appraisal Group, which is an LLC taxed as an S corporation with annual revenue between $100,000 or $250,000 and profit of $100,000 to $250,000 as well. So, we were talking pre-show, and just to give you a little bit of context, that profit from that business prior to any kind of salary or anything like that is closer to the $200,000 mark. Eric also has a martial arts school that's taxed as an S corporation with his wife, and currently not making a ton of money. We'll talk about some of the options around that. Been in business for 5 years, has 3 employees. And again, last year paid taxes of about $50,000. Eric, anything that I missed there that's kind of important, at least to that initial kind of outline of what you have going on?
No, that pretty much sums it up.
Okay, excellent. So to get started, I just want to kind of dive into some of the things about your personal story that we can help get down and drill into some of the strategies that we want to talk about today. So the first one is tell the audience a little bit about your household income, where that break in. I know we have a household income around $250,000. What is the breakdown of that household income?
Yeah, so the majority of that is through the appraisal business. That's about 200,000 a year comes from that. The martial arts school, generally speaking, breaks even for the most part. We did make a little bit of a salary or a little bit of income last year through the martial arts school, and then my wife has a part-time job as well. Those are the 3 main sources of income we have.
Okay, and for the appraisal business, we have about profit and pre-salary, profit of about $200,000. What is the breakdown of salary that you're taking, reasonable salary you're taking for yourself in that versus profit from that business?
Yeah, so the salary I take generally goes between about 120 and 140,000 a year is what I take through the business.
Got it. So 140,000, 60,000 in K1 income from the S corporation. Any salary you're taking out of the martial arts business, you or your wife?
No, we don't take any salary out of the martial arts school.
Okay. On the business side, since both businesses are operating as an S corporation, we'll kind of talk about proper entity optimization, what we like to look at there. But since both are operating as an S corporation, are you utilizing an accountable plan at all, or do you have an accountable plan set up in your business?
Yes, we do.
Okay. And what specific items are you using that accountable plan for the reimbursement pieces?
So I have a home office deduction and then a dividend that I take.
Okay, perfect.
And then the salary part.
Yeah, makes sense.
Mm-hmm.
Do you have a board for your business?
No, but we're setting that. That's one of the things that we're going to be setting up.
Okay.
Yeah.
Children, you have 2 children. What are their ages again?
24 and 21.
Okay. They live locally, work in the business at all, or have any part in that?
Yeah, my son, who's the 24-year-old, actually works for me in my appraisal business.
Okay. And the 21-year-old?
Yeah, she's still finishing up school. She has worked part-time in the martial arts business. She's currently not at the moment.
Okay. Any high medical cost or any outside of like typical insurance, things like that, is there any high medical costs that you guys are paying out of pocket?
No, not too, nothing beyond the regular things, seeing the doctor for typical medical things. So nothing out of the ordinary.
Okay, makes sense. And health insurance. So I know you mentioned your wife has a part-time job. Are you paying for health insurance through the business? Are you getting it through that part-time job? What does that look like?
Yeah, we get it through her part-time job. In fact,
Okay.
that's the main reason she works, is so we can get the health insurance.
Perfect. Okay. Now, before we go into more strategy, if this is something that you're enjoying or would like to go through something like this, we work with small business owners going through hundreds of different strategies every single day. And at TaxZone, we not only do we offer unlimited access to our team of tax pros, but we also have a complete system to fully implement every strategy available. So go to taxzone.com if you're interested in that and book a free discovery call with our team. All right, back to you, Eric. When we talk about entity structures in a business like you have set up, typically what we like to see is to have a main holding company, S corporation, that you own 100% of. And so the benefit of that, and you already have that with the appraisal business, which is good. The difference is that when you have separate multiple businesses, ideally we wouldn't want to have them also set up as S corporations, because when you have an S corporation, you're required to take a reasonable salary for yourself as an owner. And obviously the martial arts business you mentioned last year did $50,000
Yeah.
and kind of breaks even every year. So you're probably not taking much money out of that business because it's breaking even. And so it's not a huge deal right now, but as you start to grow that business along with the appraisal business, the problem that we see with two S corporations is, one, you're filing an S Corp tax return times two, and you're running payroll to yourself times two. So, there's obviously a payroll cost associated with that. And those costs just can be unnecessary. And so typically when we have somebody with multiple businesses, our favorite setup to do is to have an entity at the top you own 100% of. That's your S corporation. And any other business that you're associated with would be owned by that S corporation. So we can still have separation for legal purposes so that one company is not going after the other. They can still be a separate entity, but instead of setting that separate entity up as an S corporation, ideally we'd have it owned by your S corporation so that you have 3, 4, 5 different businesses underneath. They're all flowing through to your one S corporation where you run one S corp tax return and one payroll from.
Okay.
Does that make sense?
Yeah, absolutely. Yeah, that's good news. I didn't even know about that. So
yeah, and it can become especially beneficial if you get into other partnerships. Let's say that you have a friend that does consulting for appraisers. So you're an appraiser, but now you have a friend that wants to start a business that helps consult other appraisers on how to grow their businesses, everything like that. And just imagine that you got into business with them. Same thing we would do there is we'd have, even though you're a partner of it, we'd say, start that business up as a partnership, but let's have your ownership in that partnership be your S corporation. Again, sort of full flat that all of this business income that you're active in is flowing through your S corporation and up to you to that point. So just something to consider as that martial art business starts to grow, as you continue to potentially get into other businesses, just something to consider with one big caveat to that. If it's a real estate, a rental business, something that you're not active in, we do not want that owned by the S corporations. We always want to keep that separate. So you have a friend that says, hey, I'm opening up a car wash. Do you want to be the investor in it? You just fund it. You don't do anything with operations. You just give them the money for it. We wouldn't want that to be owned by your S corporation because that's a passive business. And the real purpose of an S corporation is to help minimize the amount in self-employment taxes. So any questions on that?
No, that I like that idea. Yeah.
Which, talking to that point, and I think you might have put this into some of your questions, but do you currently have any type of real estate, not that you own and live in, but any rental real estate currently?
No, but that's one avenue I would like to pursue as well.
Okay, we'll talk about that in just a second. Just kind of talk about from a strategy standpoint what that might look like.
Okay.
The second piece that I want to talk about is retirement. So it looked like you have a simple IRA currently. Is that correct?
Correct.
And how much are you ideally looking to put into retirement? And that's from a standpoint of how much do you want to fund retirement? Some people love retirement, love maxing it out. Other people are like, I just want to put enough away and I'd rather do, my own investment with other things. But how much do you want and can you afford to put away in an ideal world into retirement on an
Yeah.
annual basis?
So I have kind of three. I have a traditional IRA, the simple IRA, and then a health savings account.
Okay.
And so one of the things that I need I'd like to put in about $1,000 a month. I just which
Okay.
one to put it in, or split it between some, or and then how to get that money from the business into those accounts.
Okay, perfect. So let's talk about we'll talk about that. But before I talk about that, I want to talk about your salary of your S corporation. And the reason I was asking about retirement is because the salary proportion that you have is what I would call very safe in an area that I think you can get a little bit more aggressive in. And the times when we see people take a big salary and less owners distributions or draws, sometimes that's related to them wanting to fund a retirement account up to a certain amount that maybe they couldn't do if they didn't have as high of a salary.
Gotcha.
But at the levels you're looking at, you don't necessarily need to fund it. You don't need that high salary for that. And
Right.
so let's talk about your salary a little bit. And let's just assume last year's numbers were $140,000 salary, and then 60,000 in draws or profit from that business. When you're determining or looking at that salary, is that just a number you kind of picked and so that's what I think is good, or what are you basing that $140,000 off of?
Yeah, that was previous accountant. That was the number that she suggested.
Okay, makes sense. So when we look at a reasonable salary, of course, with an S corporation, we're required to take a reasonable salary.
Hmm.
The big reason we go into an S corp is to help minimize the amount we pay in self-employment taxes. And so when we open up an S corporation, we split our income into two pieces. Salary, W-2
Hmm.
salary, we still pay self-employment taxes on that. It's not necessarily called self-employment taxes, but it's essentially the same number.
Right.
And then the other half is owner's draws or distributions, and we avoid self-employment taxes on that. And so that's the big benefits of an S corporation is you can avoid self-employment taxes on a portion of your income, whatever you don't take as a salary. And typically, our rough numbers, when we're just talking to someone, they say, what's a reasonable salary? Our quick kind of thumb in the air is to say, let's do 30 to 50% of your profit. So
Okay.
you're going to make $200,000. Let's go anywhere from $60,000 to $100,000 for your reasonable salary. That's our
Okay.
quick back of the napkin number. From there, we say, okay, we got a starting point. $60,000 to $100,000 is a good salary. Let's look at how many hours we're putting in. What does somebody, what's the hourly rate for someone doing my job? Let's
Hmm.
break my job into three pieces. How much do I spend being an appraiser? That's going to be
Hmm.
probably the highest hourly rate of your jobs.
Hmm.
How much do you spend in marketing? So, being a sales agent, going to conferences and, doing those, selling your services, how much you do on that? That's going to be a lower dollar amount because you're not an appraisal. Now you're a marketing person,
Right.
likely get paid less than an appraiser. And then the third one is how much do you do doing administrative tasks? So think of things like kind of answering random emails, doing bookkeeping, those types of things. And so we like
Hmm.
to break the amount of time we're spending in those categories out, find how many hours we're spending on there on average. So we don't need to like track for 6 months or anything like that. Just say, okay, on average, 10 hours a week is marketing, 10 hours a week is administrative, and then I'm actually being an appraiser for 20 hours or something like that.
Yeah.
Then let's look up wage rates in your area for each of those different categories and try to back into a salary.
Okay. Okay.
So we have a starting point. If we tell the IRS, oh, we just did 30% of our income as a salary, the IRS is going to say, okay, like that's not acceptable.
Yeah.
But when we tell the IRS, hey, here's how we determine our salary. Here's how much time we spent on marketing and advertising and administrative work and actually being an appraiser. And here's the hourly rates. That's what the IRS wants to see. So I like to say the $30,000 to $50,000 is pretty much what's going to, or 30 to 50% is pretty much generally what's going to keep you under the radar. The IRS isn't going to balk at those numbers, generally stating.
Okay.
And that study of looking at how many hours and hourly rates, that's going to build that audit protection. That if the IRS were to balk at it, now we have that audit protection to back it up. So
Gotcha.
I always tell people to start with that 30 to 50%, but also run those numbers and see where that ends up. And if that ends up in that 30 to 50% range, well, we have a concrete salary that we can bump you down from 140 to 90 or 140 to, 80 or whatever that number might be.
Okay.
And just as an example, if we took you from 140,000 to let's just say 80,000,
Okay.
we're reducing your salary by $60,000. The only thing that changes is instead of taking it as a salary, now you're taking it as an owner's distribution or a draw. And by
Right.
doing that, you're saving, I'm just doing the quick math,
Sure.
roughly, $8,000, $9,000 in taxes from just that move.
Just that change. Oh, that's good.
So that's where that reasonable salary could be a really key piece to start to drill into. And obviously, a lot of people are like, my accountant told me to do it. I did it. I left it alone and we stayed with that, which is fine.
Yeah.
But now it might be time to say, hey, is that too high? Is there a way that we can adjust that and be a little bit more aggressive, but still stay in the radar? And the aggressive piece is the 30 to 50%. But so many people, when we go through this practice of actually taking out the hours of spending on these different tasks, it ends up being close to that 30 to 50%. And that's not aggressive at all because we have full backup of saying, here's how we're determining the salary. I think that's much better than just saying, oh, my accountant threw this kind of number at me.
Right.
That makes sense.
Yeah, absolutely.
So do that practice, run through how many hours you're spending in administrative, in marketing, and then being an actual appraiser.
Okay.
And if you go to gls.gov, I think it's gls.gov. It's a government website that has labor statistics.
Okay.
You can look by city and then you can look at job type. And it'll show you what the average hourly rate is based on your city and job type. So you would do like for marketing, if most of your marketing is done on the phone, you know, like what's a telemarketer make on an hourly rate in that area?
Gotcha.
And then what's an administrative assistant make? And then obviously appraiser.
Right. Okay.
And so this is something you can revisit oftentimes because we see a lot of business owners that are in the height of their career. They're working a lot of hours. And then all of a sudden they get deeper in their career. They have other people working for them and they start to lower their hours. And thus your salary should also reflect that. Even though you might be making the same amount of profit or more, if you're spending less time in it, that's okay. You know, we had a client that was making over $1 million a year that was taking a salary of like $60,000 in an S corporation, which initially you're like, that is way too low because your 30 to 50% is blown out of the water on that.
Right.
But they were spending 10 hours in their business and literally what they were doing is sweeping the warehouse. Like it was just something to keep them busy. Right.
Yeah.
That 60,000 that they were taking as salary was actually more than what they probably really should have earned based on what they were doing. But that's just kind of some context of shifts, you know, in your career.
Yeah. Okay.
So any questions on that?
No, that makes it, that makes sense. Yeah. That was never explained to me that way. It was always just take a reasonable salary and that was it. So this is good. This is great.
Yeah. And people get scared by that because, you know, this is the part that, the IRS can audit. And, you know, knock on wood, I have never gone through a reasonable salary audit with a client. I've never had a client audited for reasonable salary. And that's because we always stay in that 30 to 50% range. And that's my basis for saying why that's a pretty safe range is because we've never had problems with it. Again, not to say that that's defensible, but we've never had problems with it. And if someone's scared about it, then I say, then let's back it up with that real data so you can put it on file. We're not sending that data to the IRS. It's just if they come knocking, we have something to support that and know that we feel comfortable with the salary that we're taking.
Yeah, that makes sense.
So accountable plan. I know you said you got an accountable plan put in place. That's really good. That's important, especially with the S corporation, and definitely a way to get that home office deduction. Automobile. I'm assuming that you have an automobile inside the business.
Well, I use my personal vehicle, so I do the mileage.
Okay, so I'm assuming you're using that automobile reimbursement via the accountable plan as well.
Correct.
Okay, perfect. The next thing I want to talk about was this concept of maximizing deductions. And when we talk about maximizing deductions, we're not saying like, let's go out and buy things that we don't need. When we talk about maximizing deductions, we're saying, how can we look at spending that we're already doing on our personal side and find business purposes for that spending that we can shift that into a business expense? And so it's saying we're going to spend this money anyways, but can we find a business purpose for it?
Gotcha.
A good example is a home office, right? You have a home, you're going to live in it, but now you're getting a business deduction for a portion of those costs that you had anyways. And that's a great thing. But one thing that I noticed kind of looking at the P&L that you sent over is that I don't see, especially on the Vanderwall appraisal, I don't see much for meals. I don't see much for travel related costs, technology costs. So talk to me just a little bit about that. I feel like there might be opportunity to expand or look into some of those areas to expand that after-tax spending versus pre-tax spending.
Yeah. Yeah. So we don't have a lot of equipment, software, things like that. So there's not a lot that goes with the business that regard. We do, I've started to use a little bit more of the meals, looking at travel. We had a trip back in over Memorial Day weekend, and I looked everywhere for some sort of real estate related or even martial arts related event going on at the same time but I just couldn't find anything that weekend. But that's
Yeah.
one of the areas that I definitely would like to use more of that travel expense,
Yeah.
tying it into the business.
Yeah, and one thing that a kind of a practice I like people to look at is, and this doesn't have to be something we do every month or anything like that, but take a chance, look at like your last 6 months of if you're a credit card user and that you just pay your credit card off, look at your last 6 months of credit card on the personal side,
Mm-hmm.
or a checking account, and look at some of the expenses on there. And it's surprising. I did this practice myself, and I was going through. I was like, oh, I had a lunch with my buddy John the other day, and I was looking at that. I was thinking about that expenses came through on my personal side. I'm like,
Mm-hmm.
we talked the whole time about business, and we were talking about how he had a client that was needing some tax services and things like that, and like the whole conversation is a friend. We were just grabbing a lunch and a beer together. The whole
Yeah.
conversation was about business, and so those are some opportunities that sometimes you just don't think about those things when they come through, but all of a sudden looking backwards, it can sometimes open that up. And once you start to change that mindset of understanding, hey, can I find a real business purpose for this spending? Once you change that mindset, you start to see these opportunities pop up more and more often. So
Gotcha. Yeah.
just something to keep in the back of your mind, as well as we talked about a board, and you said you're looking to set up a board.
Yeah.
I'm a big believer that every business should have a board in their business, whether it's just you solo owning it, no employees, no other partners or anything like that, or it's a multi-billion-dollar business. Obviously, you're going to have a board as well. And
Right.
so I think that, one, you should have a board for vendor appraisal, and you should also
Mm.
have a board for the martial arts school as well.
Okay.
And that board is just basically saying this is a group of people that we're putting together that are trusted in our network. We, look to them for advice. So this could be friends, family members, it could be colleagues, whatever it might be. It can
Okay.
be 3 people, it could be 6 people, but we're finding people around us that we want to have as part of our board.
Okay.
A couple benefits. Obviously, we'll talk about the tax benefits, but one of the benefits non-tax related that I really like is it allows me, and I do monthly board meetings, so it allows me on a monthly basis to step away from my business and say, okay, I'm always deep diving into this. Once a month, I can step away from it and just talk high level about where are we trying to go and what are we trying to do in our business and what are some of the struggles that I'm facing that I don't really maybe understand or see from a day-to-day basis. And all of a sudden you get these outside people, whether it's family members, friends, colleagues, whatever it is, start to kind of get some ideas rolling for you. It allows you that kind of stress relief day to step away and look at it from a bird's eye view, because the people around you, the trusted people around you, will see your business a lot differently than you see your business.
Yeah.
So it's a great way for that, as well as being held accountable. So if you say, well, I'm really getting really getting stressed, putting a lot of work in, and I just need to hire somebody. I need to hire an administrative assistant, or I need to hire another appraiser, or whatever it might be. We can
Mm-hmm.
talk about this at your board meeting. And then guess what? You're going to see them in a month from now, or 2 months from now, or once a quarter, whenever you do your board meetings. And they're probably going to say, so how is that, hiring the new appraiser going? And those kind of things help keep you accountable, because you got to meet with your board down the
Yeah.
road.
Okay.
The other benefit is, obviously, when you have these board meetings, there might be travel involved with it. There's going to be meals involved with it. You might be renting out a space that's involved with it. So there's going to be costs from a tax perspective too. And if these are board members that you want to hang out with, you want to be around anyways, now you're
Mm-hmm.
kind of tying into those costs and thinking of that after tax versus pre-tax spending.
Okay. Makes sense.
The one thing that we also like to combo with a board is, especially if it's all local, all people that are close to you, is to utilize something called the 14-day home rental rule. Have you heard of that strategy before?
Yes.
So basically how it works is if you rent out your home for less than 14 days total throughout the year of any type of rental, it's not rental income to you. You don't get any expenses associated with it, but there's no income to offset anyway. So it's
Right.
tax-free income to you.
Okay.
And typically this makes sense. Like, let's say the Super Bowl's in your town and you can rent out your home for, $5,000 a day for a week. Obviously, if you do that for a week, rent out your home for $5,000, you don't have to pay tax on that. That's great. But if you don't have a situation like that, we love to kind of combo this board meeting with this home rental. And
Gotcha.
so the key thing when we talk about the 14-day home rental, it'd be a way, if you did that, let's say you said, okay, the third Wednesday of every month, we're going to have this board meeting at my house in an area that's not where I normally do business. So it's not going to be in my home office. It's going to be somewhere else.
Gotcha.
We find out, okay, what would it cost to rent out a boardroom at a local hotel or a co-working space? And let's say that's $500 a day. Now we could rent out our home to our business, get a business deduction, and we pay no income taxes on that. As well as the meals and everything else associated with that board meeting would all be part of that deduction.
Part of that. Okay.
Key thing is can't be hosting this board meeting in the same place that you do business. So if you're hosting your board meeting in your home office, that's just going to be part of the home office deduction, not a separate deduction. But if you're hosting it in your kitchen and your living room and your dining room and everything else, well, that would be, a separate location.
Gotcha.
And then the second piece is understanding what is a reasonable rate. So what would co-working space down the road cost for me? And what does that look like?
Gotcha. Okay.
Any questions on that?
No, is that kind of part of what they call the Augusta rule? Is
Exactly.
That yeah.
Yep. Yeah. Same thing. It's a same strategy.
Yeah.
The Augusta rule is kind of where it got its name from because if you think of if you're a golfer, watch the Masters tournament. That's in Augusta, Georgia, and there's a ton of people come there and they just have no place to stay. So they rent out their homes for really high dollar amounts during that week. And that's kind of where that concept kind of came around.
Kind of came from, yeah. Yeah, we've done it with the martial arts school where we've had like a summer party and used our house for that.
I love that. I love doing it, having a team retreat, something like that, where you're doing it the same way. Again, biggest thing is business deduction, no taxable income to you up to 14 days. So you could even, if you do quarterly board meetings, you could do that. That's only four times. If you do monthly board meetings, that's 12 times. If you do a monthly board meeting and a team retreat, now you're at 13 times. So there's ways that you can kind of adjust that. I've also done seminars. So it's like a virtual online seminar, a couple days long. Where normally I would do it in my home office, but for that seminar, I decided to have a different setting, did in our living room, different things like that, different backdrop, and utilize that strategy for that as well. So a lot of kind of potential there. Hiring your kids. So you mentioned your son. Is your son working full-time in your business?
Yes.
Okay, perfect. And your daughter is finishing up school.
Correct.
Are you supporting her in any way in either paying for the school, paying for meals, car, supporting her in any way currently while she's going to school?
Yes, we help her out with some of those expenses.
So the biggest thing that when we talk about hiring the kids, it's a super powerful strategy, right? Because as a father too, we're always supporting our kids in many different ways.
Yes.
And so when we're hiring our kids in our business, it's taking that concept of after-tax spending versus pre-tax spending. And so when we talk about kids under the age of 18, we can hire them where we get a business deduction. They potentially pay no income taxes on that, and there's no FICA withholdings, and there's workarounds and things that we can do for that. But once they turn 18, now if we hire our kids in our business, now we have to do the FICA withholdings. We have to do those different things. If we're hiring them as an employee, if we can hire them as a contractor, then it would just be a 1099 for us. They'd get a 1099. They pay self-employment taxes on that, but since they're a 1099 contractor, now they're going to have costs associated with that as well, that they can offset some of that 1099 income. So, for example, with your daughter, I don't know what she's going to school for or anything like that, but what I would always encourage people to say is, can we find something that they can do in our business, whether it is social media posting. We send all of our pictures, videos, things like that we want to be posted on social media, we'll send that to them. They'll post it for us. Maybe it's $1,000 a month that we're paying them, $12,000 a year. They can now offset that with costs related to their internet, their home office that they're operating in. Maybe they travel to see their client, which is now you. So there's costs associated with that. Those are just some really good opportunities. Again, you're going to be supporting her anyways. So is there a way that we can at least get a business deduction for some of that support? And so once they turn 18, we typically say we don't want them to be a W-2 employee anymore. Now we want them to be a 1099 contractor. So we can pay them as a 1099 contractor, but they can offset a lot of those expenses. Now they're probably still going to have some taxes to pay on that, but they'll be able to offset a lot of that income with regular everyday expenses associated with the work that they're doing.
Okay.
The biggest thing is that if they're a W-2 employee, so like this probably wouldn't work for your son, because if he's full-time in the business, he's a W-2 employee, looks like an employee, acts like an employee, everything's an employee, they got to be an employee. Yeah. But if it's a college student doing some social media work for us or some random administrative work for us, much more doable to kind of work in a contractor type relationship.
Okay. Interesting.
Does that make sense? Any questions on that?
Yeah. I had not heard of that before. So that's interesting.
All right. So let's talk about some of the questions that you had related to traditional IRA, simple IRA, HSA, real estate. Let's start to kind of dive into some of those things. So you mentioned that you're looking to put about $1,000 a month away towards retirement, something somehow, some way. So $12,000 a year. And your question is how much of that should be a traditional IRA? How much of that should I put into a simple? How much of that should I put into an HSA? And where do I pay that from? Is that pretty accurate?
Yeah. That's exactly it. Yes.
So, the first thing is I love doing an HSA, maxing out an HSA every year. Yeah. And the question is why? You get a tax deduction going into it, and it gives tax-free growth and tax-free withdrawals. So it's like a retirement account, but it's on steroids. So the good thing about a Roth is it grows tax-free, withdrawals tax-free. Bad thing about a Roth, you don't get a deduction going in. The good thing about traditional IRA is you get a deduction going in, but grows tax deferred and tax on the withdrawals down the road in the future. Right. Where an HSA has the benefits of both of those. Deduction in, tax-free growth, tax-free withdrawals. The only difference is it's limited on has to be medical costs that you're paying with it. And so a few things that I would say my just off the cuff recommendation is to first fund the HSA. Okay. Because a couple different reasons and a couple things we need to make sure that we're keeping it top of mind as we're funding this HSA. First one is I like to pay for medical costs out of pocket as they come along. So even though we have an HSA with funds in it, as long as I can afford medical costs, I'm going to pay for them out of pocket as it comes along. And the beauty behind that is that let's say 7 years from now, you hit a money crunch. You're not into retirement yet, so you can't access any type of retirement accounts anyways, but you're in a money crunch. What you could do is you could take those receipts from those medical costs that you've been accumulating over the last 7 years. You can ask for a reimbursement from your HSA. That'll be tax-free for that. So it allows you to an HSA, you can start to access a lot of those funds prior to like a retirement type age. The other thing is that it grows tax-free. So we like funds in that vehicle to be growing, to be really doing good things in those. So many people will fund an HSA and it'll sit in like a high yield retirement account earning like 3% interest or something like that. That's fine. But if we're going to do this HSA and we're going to max out an HSA and we're going to do it as sort of a semi-retirement account or a secondary retirement account, we want to make sure that we're investing those funds in that HSA just as we would a retirement account. So we want to be just as aggressive or just as safe as we would in our retirement accounts with those HSA funds. So as we're funding that HSA and then not using those funds for medical costs unless we need to from a cash standpoint, we want to make sure that we're actively investing that in the type of market and the type of things that we would invest anyways in. Okay. Does that make sense?
Yeah, absolutely.
And so then the next piece is, so I would go HSA number one. Okay. Then I would max out your IRA as long as you qualify, you're under the income limits, max that out. And then
Okay.
anything else go into the simple.
Okay.
So your IRA and your simple are going to be treated very similar, as far as tax purposes, when they come to withdrawals, treated very similar. What you can invest in, treated very similar. So whether you're funding a traditional IRA or a simple IRA, doesn't make much of a difference to me. It would just be the amount of money you can put in there. So obviously you're capped at traditional. Once you hit that cap, move to the simple.
Okay.
If you hit the simple cap, now we're probably going to let's look at a solo 401k for your business. Obviously with $12,000 a year, we're not going to have to worry about the simple cap. But if you were to ever hit that simple cap, now we might be looking at let's transition to a 401k for your business. If you have employees, so it'd be a safe harbor 401k that we could do that would increase that cap as well.
Okay.
As far as, do we fund it from the business account or the personal account?
Right.
So the HSA, you have two options. You get the deduction for the HSA contribution. You get that deduction on your personal account. So that's one thing to consider, is that deduction is going to come from your personal account.
Okay.
But a cool thing with an S corporation is that we can make that contribution to an HSA through the S-Corp business, and it will be included as reasonable salary to you, but it's not going to be subject to self-employment taxes, not going to be subject to FICA taxes. So it's a little bit more complicated. It takes a little bit of tweaking with your payroll provider, but there is a really cool benefit there where we can get that HSA inside of the business and add to that reasonable salary that we talked about earlier, but not getting hit with FICA taxes. So if you're funding an HSA for $8,000 as an example, that's $8,000 that would be considered reasonable salary that you're, again, double avoiding FICA taxes on.
Interesting.
Traditional IRA, you're going to pay for personally. Now, if you pay for it through the business, totally fine. Just mark it as a draw or a distribution.
Gotcha.
No business deduction for that. And then the simple, any employer contributions would be, you would fund the simple through the business. You're going to be at the employee contributions that are going to consider wages. So they'll show up as a wage expense. And then the employer contributions are going to be a separate line item on that business return. So
I see.
You can fund all of these through the business. Traditional, it's going to be an owner's draw no matter what. So you're not going to get a business deduction for that. That's why I always just say fund it personally. The simple, you would need to or need to run through the business, as well as factor into your payroll. And then the HSA, you have an option of funding it through the business or funding it personally. The tax deduction is going to be the same on the business side. If you fund it or on the personal side, you're still going to get that HSA deduction. If you fund it through the business, you have that possibility to avoid some FICA taxes, but a few hoops you have to jump through. So if you're using a software like Gusto or something like that, you'd want to kind of talk to them about those options.
Okay. Yeah, we use Gusto, so I'll reach out to them. Any
questions on that?
No, I don't think so. That makes sense. So I like that.
Okay, perfect. And then talk to me, last item here, before we cut off, talk to me a little bit about real estate and kind of what you were thinking from that standpoint.
Yeah, I'd like to, as I understand it through my appraisal work, I may qualify for professional real estate status. So I was looking at purchasing a rental property and trying to decide if I should fund that through like a HELOC, or I've heard that you can do like a Roth IRA, fund it through a Roth IRA, something like that. So that's one area that I'd like to explore.
Yeah. So rep status, real estate professional status can be super powerful when you qualify for it, because it allows you to take losses from real estate, which real estate generally will create a loss, especially if we're doing, a cost seg study with that real estate, but allows you to take losses with that and offset W-2 income, business income, which can be super powerful.
Yeah.
Now, if we do that investing inside of a Roth IRA, and I love self-directing retirement accounts, but if we do that investing inside an IRA, you're not going to see any advantages on the personal side from that. So you're not going to be able to, rep status doesn't matter. If you're investing inside of a retirement account, and that could be a Roth IRA, that could be a simple IRA if there's a self-directed piece to that, that could be an HSA. You can self-direct an HSA account and invest in different things that you want to.
Gotcha.
So you can choose all those different options, but you're not going to need rep status if it's inside of that retirement account.
I see.
your rep status comes into play when you want to take losses to offset W-2 income or business income.
Okay.
So using a HELOC to fund that, using another, just an investment type loan to make the down or to purchase that house with some down payment, things like that, that would all be allowed and available for that.
Okay.
The biggest thing is understanding what type of property we're looking at, what type of tax advantages are we looking for, and do we want to run a cost seg study on it or not? Do we want to accelerate the depreciation? With the one big beautiful bill, one of the advantages to that was bonus depreciation's back at 100%. So
Gotcha.
what that means is that if we did a cost seg study, let's say that you bought a house or a rental property worth $500,000. Let's say the land value of that was $100,000. So the actual building value was $400,000.
Gotcha.
We can run bonus depreciation, but we don't get bonus depreciation on $400,000. We only get bonus depreciation on the property that we can pull out of that building that is less than 15 years in a lifespan of it.
Okay.
Typically, we say roughly 30% of the building cost can be depreciated quicker. So we would take that $400,000, we'd multiply it by 30%, and that would give us $120,000. So if we did a cost seg, we bought a building for $500,000, there was $100,000 that's attributed to land. We can't depreciate land. So now we have a $400,000 building. 30% of that's $120,000. In that 30%, we could likely bonus depreciate. Obviously, there's just rough numbers and rough ideas,
Right.
but that's the amount that we could take as bonus depreciation. So
Okay.
let's say you bought a house for $500,000. You put 20% down. That's $100,000. You're getting $120,000 deduction in year one as a loss that can be used to offset your W-2 business income. So that can be a super powerful way that we can just continue to compound on that.
Yeah.
And even if you weren't a real estate professional, you could also do it with a short-term rental. So if it's a rental that had an average rental day of 7 days or less, that would be possible as well. So a lot of planning there. Just know that if you decide to self-direct, purchase that through a retirement account, that's going to look a little bit different. There's the tax benefits. I love getting into real estate and retirement accounts, but you're not seeing that tax benefit today. You're going to see it down the road when that's appreciating and everything else.
Gotcha. Makes sense. Okay.
Now, real quick, if you are not quite ready to book a discovery call with our team at Tax Zone, but still want more, we just released a brand new tax savings starter kit, and it's 100% free. Inside, you'll get our ultimate list of business deductions. You'll get a real case study similar to this, showing how others have saved $5,000 to $25,000 or more in taxes. Just head on over to taxsavingspodcast.com/starter kit to get your free copy. Again, that's taxsavingspodcast.com/starter kit. So, Eric, I've really enjoyed this conversation, and I know we've kind of walked through a lot of different things at a high level. Really what I say is this is just kind of starting to scratch the surface. There's a lot of work to do from here. If we look at reasonable salary and adjusting that, doing some work there, we want to find out what is that reasonable salary. And maybe we're just stopping salary for the rest of the year. If you've already hit your reasonable salary, maybe we say, okay, we're going to turn that off. We're not going to run any more salary. Just take it as owner's distributions, owner's draws. But there's some work that we need to do there. If we look at the 14-day home rental rule and the board and getting that set up and maybe hiring your daughter in your business, a lot of things that we can do from here. But again, I want to just kind of do an intro call just to kind of unpack some of the potential in tax planning opportunities. So was this helpful? Was there some kind of things that you're like, oh yeah, like that's something I need to be doing or thinking about doing, or some next moves that you're going to be taking based on our discussion today?
Absolutely. Yeah, I learned a lot just in the time we've spent here, things that I didn't know about. So yeah, I'm really excited.
Yeah, and once income hits, say $250,000 to $300,000 or more, which you're kind of right on the edge of that cusp, it really opens up the door for not only what we call core tax strategies. And a lot of what we talked about today is core strategies. You know, the S-Corporation, real estate, retirement planning, hiring your kids, 14-home rental rule, maximizing the deductions, and all those different things are what I call core tax strategies. And we want to utilize them to their fullest extent. Once we fully utilize them, then we look to what we call advanced strategies. And typically, again, that's going to be once your income hits $250,000 to $350,000 or more, it opens up the door to some more advanced strategies that we can look at, and a lot of different planning opportunities along with that too. So, as you're growing your business, as you're saying, okay, we got this down now, we've lowered our tax bills from maybe $50,000 last year to maybe $30,000 or $20,000 this year. Let's look at those savings and then business is growing again next year. We're back at that $50,000 just because we've had so much more income again from business growth.
Mm-hmm.
Then let's start to kind of look into some more advanced strategies as well.
Makes sense.
So Eric came in thinking 50,000 in taxes was just part of doing business. But today we uncovered real, actual ways that he could bring that number way down. And here's the truth. Most small business owners are in the same boat. They're leaving thousands of dollars on the table without even realizing it. This live case study wasn't just about helping Eric. It was about showing you what's possible when tax strategy is done right and intentionally. So if you found this helpful, don't forget to subscribe. Hit that like button and share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax professionals implementing a lot of what we talked about today, along with so many other tax strategies, visit us at taxelm.com. That's TAXELM.com, or click the link in the description for a free discovery call. We are helping people like you legally lower your tax bill every single day. Eric, thanks for coming on, and everyone else, we'll see you on the next one.
Thank you.